Okay, hi everyone, and welcome to part 2 of this podcast. We're talking money with Steve Cronin, and obviously we started and we couldn't finish because it's such an exciting topic to talk about. I'm sure lots of people don't find this exciting, but I find it exciting because when you get your money right, I think your life starts to flow in a nice way. So welcome back, Steve. It's nice to have you.
Thank you so much, Lisa. And it's such a good point. You know, like if you get your money wrong, your life can be really, really miserable. Yes. And if you can get it right, then it can be so much better. It's a huge weight lifted off your shoulders. And I get like nice, one of the joys of doing my job is that I get nice messages from people saying like, I feel just calm and confident and not stressed about money. And anyone listening to this can absolutely do this for themselves.
Which leads me nicely into what we couldn't finish was investing. And so today we're going to dive into your investing journey and what you do. And I just want to taper this with, this is not financial advice. So for people listening, I don't want you to think this is prescriptive. We're not financial advisors. I, by no stretch of the imagination, could class myself as anything financial, let alone an advisor. So I know that my journey with money obviously evolved as I grew older and I started to self-educate. So I'd like us to treat this podcast as one of your self-education tools on your road to discovering how you want your finances to look now and in the future, right? So my first question really is, how did you decide what your investment journey would look like when you started on this journey?
Well, I made loads of mistakes along the way. And that's why back then, even 2012, 2014, there wasn't much information out there for expats. And that's why I'm so passionate about helping expats because it's just so easy to get stuck. It's much harder for expats to invest and to get the right information. But when you do get the right information, it's actually fairly simple. So back in the day, I was advising banks. I was advising sovereign wealth funds. These are the entities that manage the hundreds of billions of dollars of countries, right? So I knew a bit about investing, but I didn't necessarily know about how to do it personally. And so I nearly got stuck in a long-term savings plan with a financial advisor. And I think that moment really woke me up. When my friend said, don't do it, it really woke me up. And I realized that I had to start taking control of my own finances. And fortunately, because I had a background in psychology, because I had a background in financial services anyway, I've been able to learn it fairly quickly. But it still took me about 4 years to figure out exactly what to do. And now what I want to do, I don't want anyone to take 4 years to figure out what to do now. I try and distill down the essences of what you have to do and simplify it as much as possible and make it as practical as possible so people understand, okay, this is what you have to do. This is what you don't have to do. I got a message from someone today and they're like, well, you know, I've got lots of money to invest, but I don't know about stock losses and making a trade and all this sort of stuff. And stuff. You don't really need to know about a lot of that stuff. You could go and buy one of these courses on stock market trading and for like $2,000 or whatever. And you could spend 2 months learning about technical analysis and reading charts and how to buy stocks and options and derivatives. And then you realize at the end that it's completely useless. So there's a lot of rabbit holes you can go down. And hopefully I can show you today the very few things that you need to know, and then you can just ignore the rest.
Yeah, I know for sure that it does seem complicated when you're starting. And it's quite confusing because we've not been prepared. We've not been taught at all in school. I know that people are trying to change this now and people are trying to get children more financially educated and aware, but it's still very, very small amounts. So for us, in my generation, making it myself sound particularly old, but we weren't taught this. So when I started on my journey, I had to dig and search to find the answers. My question to you then is, what do you recommend as an investment? Again, this is not advice. This is just your recommendation. I have some money. I've been saving. It's in the bank. That's not the best place to keep your money. I want it to grow. What do I do?
Yeah, so I think the first thing is to reiterate what we said in the first part of this podcast, which is you need your cash buffer, right? Just to sit there and just be cash. If you're going to save up for something like a wedding or a new car or property, then that you need to build up those sinking funds also in cash. But once you've got that cash, then you can start putting money in more risky investments, whether that's a buy-to-let property or stocks and bonds. Let's focus on stocks and bonds, because I think that's the bit where people get stuck the most and they just have no idea where to start. I think the first thing is don't take any financial advice from anyone wearing a suit, because they are going to probably be out to get commission from you and they won't have your best interests at heart. You can see I'm wearing my most unexciting t-shirt today. That's always a good sign that someone is probably just going to give you some helpful advice or helpful recommendations rather than put you in some horrible long-term savings plan. So the first thing to think about really is to get a bit of an understanding of the stock market. What is the stock market? What are stocks? What are bonds? At the end of the day, what you need really is just a two-fund portfolio, which is going to be a global stock fund and a global government bond fund. And we'll unpack that in a bit so you can understand what that means. But really, the stock market, you have to understand, is going to grow your wealth faster than anything out there over the long term. I'm not including crypto because we just don't know enough about where crypto is heading. It's only really been around for 10 years and it's only been mainstream for what, 1 or 2 years perhaps. So we just don't know what's happening there. So I'm not including crypto, but otherwise compared to gold, commodities, property, things like that, stock market investing is going to grow your wealth faster than anything else. And so as an expat looking to build some kind of pension replacement that's going to support you, it is a great thing to invest in. So let's have a look at a stock. Well, a stock, you're literally the owner of a piece of a company, right? And so you get the upside if you think that Starbucks is going to grow into more countries, new muffins, things like that, then the stock price over the long term is going to go up. And so that's why we invest in these companies, because the risk is that if Starbucks falters, and over time, most companies do kind of screw up, right? If we look at Lehman Brothers, if we look at General Electric, if we look at Eastman Kodak, all of these companies that were huge and successful just kind of crumble away. In the case of Lehman Brothers, like literally went to zero. I think that's what people are terrified of, that risk. And when I ask people, what's the number one word that you associate with investing in the stock market? They always come back with the word risk, right?
Okay.
So
thought they'd say Bernie Madoff, but okay.
Well, yeah, exactly. Just like everything disappearing, right? You can make long-term average, let's say you can make 7% per year in the stock market. And the beauty of that is it's going to compound, right? So 7% on top of 7% on top of 7%, it's going to look like kind of a COVID curve, right? It's going to go up almost exponentially over time. But with that comes risk, right? Return and risk are like intimately connected. And so if someone comes to you and they said, hey, I've got this product, invest in litigation funds or invest in UK properties or whatever, and we're going to make more than 10% per year, I would just run away, right? Run away. And this is why it's important to know how to do this stuff yourself so that you don't fall prey to someone who's trying to trap you, because there are a lot of sharks out there. Yeah. So what if we could hold on to that 7% return, which is coming a bit from the stock's profits going up, them expanding, a bit of inflation in there as well, and then some dividends, some of the profits that Starbucks might make every quarter. Some of it's going back into muffin research and things like that, but other chunks of that money are literally coming to you in your account as cash. when we add all that up together, the growth and the dividends that you're getting, it's about 7%. But what if we could keep that 7% and reduce the actual risk that we're facing? Then that would be a whole lot less scary. And there are 3 ways that you can reduce that risk. So the first way is to be in the market for a very long time, right? If you put your money in the stock market at the start of the morning and you take it out at the end, you have like a 46% chance of having lost some money, right? It is literally like gambling. So we're not interested in that. We're not doing day trading. We're not sweating over the charts or anything like that. If you keep your money in the stock market for 20 years, there's never been a 20-year period when the stock market has been down, right? So your money is safe. It's not gambling. The thing is, you have to have that long time horizon. And because stocks grow over time, it doesn't matter what the stock market's doing now. You can be literally terrified of the stock market going up and down, or waiting for it to dip, or be terrified that it's going to crash or whatever. But actually, from the vantage point of 10, 20, 30 years into the future, whatever little wobbles we see today just will not matter, because it will have gone up so much. And so you have to have this long time horizon. And that's why we have the cash buffer, so that the money that you are putting in the stock market, you're putting it away for 10, 20, 30 plus years, right? Lisa, you're going to live to 103 like my grandmother. And so you've got like decades, you've got decades, right? Decades to invest, all the way till, you know, your very old age. You can keep all these shares, and you're just going to take a very few out each year in retirement, and hopefully not need to touch them before then. So it doesn't matter if you're moving country, doesn't matter if you're about to retire. Essentially, you're going to buy these stocks and you're going to hold them for extremely long time. The second thing, so that's the first thing. The second way to reduce risk is to diversify massively, right? If you hold an individual stock like Lehman Brothers, or the stock that my parent company, when I was working for a corporate, the parent company, their stock price went down 52% in one day, right? In one day, because the New York Attorney General sued them. And it was a total disaster. But what did the rest of the stock market do? Nothing, because they weren't being sued, right? So if you can just buy the whole world the way that money has been allocated across all the different stock markets in the world, right? If you add up the US stock market and the Japanese stock market and the Chinese stock market and the UK stock market, all of them, you can just allocate them and buy the whole world. It's like 3,500, 4,500 stocks. You can do this these days at the click of a button. So it's super, super easy. You can just buy the whole world. And that's going to be roughly about 57% US, and then 8% Japan, 5% China, 4% UK. It's about 90% developed countries, and then about 10% emerging markets like Saudi, UAE, Vietnam, things like that. So when you buy the whole world, you don't have to think about investing. And this is the key, this is the secret to investing, is that it should be completely brainless. Right. And lots of people don't realize this. They think that you should be like reading up on companies and analyzing their numbers and the management skills and all this sort of stuff. Total load of rubbish, right? The less you engage your brain with investing and the more you stick to the process, the better you will do. And therefore, you just need to save your brain power for work, teaching, right? That takes brain power. Hanging out with your family, doing hobbies, seeing your friends. And so you can use your brain power on that. When it comes to investing, no brain power whatsoever. About 5 minutes per month is all you need. It's super simple. So that's the second way, is just to buy the whole world. And then the beauty of this is you're not lying there in bed at night thinking, should I increase my allocation to the US? Should I reduce my allocation to China? Like, it doesn't matter. Like, don't try and second guess these things. Just buy the whole world. And if one starts doing better than the other, then naturally you will buy more of the one that is more successful. Right. So that is what makes it very, very easy. And we'll talk about in a second how to buy the whole world.
I was going to ask you. Sounds nice, buy the whole world, but how do you buy the whole world?
It is nice. It is nice because what people don't realize is that you're so overexposed to your home country. If you're from the UK, for example, you're massively exposed to the UK in ways you can't even imagine. You've probably got cash there. You might have a property there. You've got your parents there. You might go back and get a job there one day. You might retire there. You're massively exposed there. But people in the UK don't think, oh, I should just buy the whole world. They just buy like the UK stock market. And that's not true resilience, right? Just like you don't want to buy shares only in Middle Eastern companies, right? Because if there's a problem, the oil price goes down, you might lose your job and you might lose all your savings as well in invested in the stock market. So that's why global resilience is really, and diversification is really important. Now, the third way to reduce risk is to keep fees super low. So anyone who's into financial independence is obsessed with reducing their fees down. Now, the problem with these long-term savings plans is that they have fees they claim like 1.5%, but really when you add everything up, you see what funds they're invested. It might be mirror fund fees, there's trading fees, there's platform fees, there's advisory fees. When you add them up, they're more like 4%, 5%. These are the most expensive plans in the world, right? And you say, well, 4% doesn't sound like a lot, but 4% out of 7% is like 60%, right? So it's a lot. Right. So every 1% that you're spending on fees is like 13% of your profit getting taken away from you. And that matters over time with the compounding. So I like to say, try not to let your fees for everything to do with investing get above 1% of your money per year. And that will really protect you against lots of sharks and leeches and people who are trying to squeeze money out of you. So just to summarize, these are the 3 ways to reduce the risk while keeping your returns. The first is invest for a long time. Second is diversify globally. Third is to keep fees low. And that's then we can talk about how to actually do this.
Yeah, because these are really good things, because I think what happens, especially with the fees, is that we don't actually know some of the fees. They're also hidden when you get these plans and all these things that people offer you. They look attractive. The brochures are glossy. The photos are beautiful. You look like you're gonna be a gazillionaire in 5 years or something. So you don't actually examine the fees and what you're losing when you're signing up. But the way you've explained it makes it really simple. But it also leaves a couple of questions that I'm sure teachers are asking. One is, where do we buy this whole world? How often do we buy it? How easy? How do we even start on that journey? So can you walk us through that?
Sure. And I think anything to what you said, like anything with a flashy brochure, anything that seems complicated that you couldn't explain to your grandmother, anything with lots of fees, just run away, right? Just run away. Because the more complex something is, the more easy it is for them to hide lots of fees in there that you can't see. So simplicity and transparency is everything. Now, how do you do this? Well, this is what took me many years to figure out. There are 2 secret ingredients to expat investing, okay? So this is the first one. You need to invest in something called exchange traded funds, okay? ETFs. I like to think of it as expat total freedom because they are so amazing, right? And the day I discovered these, I was like, hallelujah, this is incredible. What this means, okay, is that the problem that most expats hit is that you may come across a company like a massive fund manager like Vanguard or iShares. These are the biggest and best fund managers out there, allow you to buy in the whole world at the click of a button, unless you're an expat. Exactly. And you phone up and you're like, hey, Vanguard, I'd like to invest in your platform. And they're like, no, you're an expat. We're not interested. We've only just gone into the UK with our platform. So we're certainly not interested in the Middle East. And you hit this massive brick wall. And instead, what you need to do is you can't buy mutual funds, which are kind of the normal funds. You have to buy what's called exchange traded funds. And what all this means is that this is a fund that invests in multiple stocks, and you can buy it on a stock exchange just as easily as you could buy a share in Apple or Tesla or whatever. And we'll talk about how to buy stocks on those exchanges in a bit. But the key thing is that if you want to buy the whole world, then Vanguard and iShares, they provide these funds such as VWRA. They've all got these like 4-letter ticker code names, which is the Vanguard FTSE All World ETF. And that has like 3,500 different stocks in it across the world. It's massively diversified. And therefore you can just buy one share in that ETF if you want to. And then the underlying value of that share, the price of that share going up and down is going to be driven by those 3,500 stocks. So you are literally buying the world at a click of a button. And that's how you get to invest in 5 minutes. So all you need to do to get good at this kind of investing is to understand what kind of stock ETFs you need to look for. So generally something from Vanguard or something from iShares, they're the two big fund managers. You need something really that covers the whole world. So I think the two good ones personally, and these are the ones that I use myself, are the Vanguard FTSE All World Fund and then the Vanguard ESG Global All Cap Fund. Now, what does that mean? ESG stands for Environmental Social Governance. So there's a bit of an environmental filter there. So they're filtering out tobacco companies, they're filtering out oil and fossil fuel companies, they're filtering out gun manufacturers, things like that. So those two funds, and you can look these up very easily. If you just Google VWRA fact sheet or V3AA fact sheet, you'll see all this information there. And another little point here, I'm not wanting to get too technical, is that most of us who are non-US citizens, we should not invest in US stocks. We should not invest in US domiciled funds. When I say domicile, that word means where is the fund based for regulatory and tax purposes, right? Oh, okay. Most exchange traded funds, most ETFs are based in the US. You want to avoid those because if you invest lots of money in there and then you die, then you could, your beneficiaries, your kids or whoever, or your mom or whoever's the beneficiary, they could get taxed 40% on whatever you have in there, right? So it's well worth avoiding. It's much better to stick to something, say, like Irish domiciled funds. So even if you're investing in the whole world or the US stock market or whatever in dollars, you look for funds that are Irish domiciled. When you go to the fact sheet, it will say domicile Ireland, and that means that they have 0% inheritance tax, estate tax, whatever you want to call it, when you die. That's much better. So I'm like trying to keep the jargon to a minimum here,
No, I appreciate it.
That point about domiciles is really important, because I don't want you to
What about if you're an American? Should you still try to get funds that are domiciled outside of the US?
No, I think if you're an American, if you're a US resident or citizen, then you won't face that massive tax. It's only for non-resident aliens, I think they like to call us. And so if you are a US citizen, you can invest in, say, a Vanguard total stock fund, like something like VT or something like that. You don't have to worry about this. But for those of us who are not American, we do need to worry about it. So that's how you would buy a global stock fund. And then also, because we know, like, even if you're massively diversified, the world economy is quite connected, right? And so we've seen 2001, the dot-com crash, 2008, the financial crisis, 2020, the coronavirus. It's enough to put all the world's stocks down, right? The whole stock market goes down across the world, right? And that's just unavoidable. And what you have to think, this is where, like, stock investing is all psychological, right? When you're investing in real estate, it's all about hassle, right? You have forms to fill in. You've got to deal with agents, solicitors, broken boilers, tenants, tax laws, blah, 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 endless forms. a total disaster, in my personal opinion, right?
Definitely. Your personal opinion, I do not agree with the real estate piece, but we'll talk.
I think property investing is a massive hassle. So I don't love it. Compared to stock market investing, you're just literally clicking a button once a month, right? So there's no real hassle there. The hassle is all mental. The hassle is going, what if the stock market's going down? Or reading articles that saying the stock market's going to crash, or the stock market's going to boom, or whatever, you know. And so really, you have to work on your mindset when you are investing, so that when the stock market does crash, then you're happy and you think, oh, I can pick up all these stocks at a bargain and I'm then going to hold for the next 60 years, rather than you panicking and selling everything at the bottom. Right. Yeah. So the analogy that I like to use, I'm sure teachers like a good metaphor, right? So it's a little bit like buying a hotel in southern Florida, right? And you're going to get loads of money from loads of tourists, but you know that every 8 years or so, a massive hurricane is going to come through and blow through your hotel and trash the whole place and leave you with a big fat bill. Okay. But the good times make up for that bad moment, right? And you're prepared for it because you know it's going to come in advance. It's exactly what stock market investing is like. The reason that you're getting that 7% is because there is risk. And you know that every 8 to 12 years, a huge hurricane is going to blow through the stock market. Everything's going to go down. So in 2020, it went down about 32%. In 2008, it went down 52%, but only temporarily, right? And as long as you are prepared mentally and you don't panic and you don't sell at the bottom and you know, crystallize those losses that you've made, then it doesn't matter, right? And you can sail through again. And the important thing to remember is that when I say that you make 7% long-term average, that includes the year that's down minus 52% or down minus 32%. So it's not like you're making 7%, and then suddenly you lose everything, right? It's that the good years are like way, way better than 7%. And then the bad years come along occasionally, and then the average averages out to 7%. So as long as, this is the secret to investing, as long as you can like hold onto your seat and stay calm mentally, then you will be rewarded with that 7% compounding year on year on year. So yeah, sure. So this is why you hold bonds, because having a global bond fund, what happens with the stock market, obviously, is the closer you get to retirement, you don't want these crazy ups and downs, right? And so a bond fund, bond ETF, when stocks go down, typically bonds go up in value because everybody flees out of stocks. They're too risky. All the pension funds and institutions, they flee out of stocks and they move into bonds, and that pushes the value of bonds up. So if you hold a mix of stocks and bonds, then your portfolio is not going to be as wild, right? During the big crashes, your portfolio is going to go down a lot less and it will recover faster. So that's why it's good. And especially government bonds, because governments are like the ultimate safe investment, really. I don't think a Boeing bond or a Carnival Cruises bond or an EasyJet bond was going to protect you during 2020's crash. But you know, everybody fled into US government bonds and other government bonds. So if you just have a global government bond fund, something like IGLA or IAAA, you can go and like just Google IGLA fact sheet or whatever. Then you can offset some of the craziness of the stock market. And as you get closer to retirement, then you move, you know, if you're under 45, you might be in, say, like 80% stocks, 20% bonds. If you imagine, I call it the Pac-Man portfolio, right? I mean, you imagine your little pie chart, a little Pac-Man. So when you're younger, you know, your Pac-Man might look like this. And then as you get a bit older, it starts to look a bit like this. And so when you retire, you might end up in like 60% stocks, 40% bonds. But still, you've only got two funds. You've got your global stock fund, global government bond fund, and that is all you need.
We're going to pull it back because, you know, I listen, I'm a teacher, so I need step by step by step.
Okay.
Now, this is not financial advice. I get it. But let's say you've listened thus far to part one. You're now at part two. You've got your cash buffer set aside. You've got yourself on a path now to start investing. You know you're going to buy the world. You know you're going to mix your stocks and your bonds. You know you're going to keep your fees low, and you know you're in it for the long term. So you know this, like you're on it and you want to win, right? I want to know where I start platform-wise. I want to know, how do I then ensure that I'm getting the lowest fees in terms of the platforms that I'm choosing? So do you know any platforms that you could recommend and how we could get started? So we're going from start.
Yeah, absolutely. And so this is the second secret ingredient of expat investing. We've had that, the ETFs, the exchange traded funds. And then the second part is, how do you buy those ETFs? It's just like, I mean, the problem is very similar to trying to buy, you want to buy 5 bananas and you phone up Chiquita and you say, I want to buy 5 bananas. And then Chiquita says, well, no, we're not going to sell you 5 bananas. Maybe we'll sell you 5 pallets of bananas or 50,000 bananas. So what do? Instead, you have to go to Choitrums, you go to a supermarket whose business model easily allows you to buy 5 bananas. And this is the same problem, right? Because Vanguard doesn't want to deal with you on their platform. So you need to go to an international brokerage. It's almost like a fund supermarket, right? And they allow, if you want to buy 1 share of VWRA, you absolutely can. Now, there are many, many brokerages out there. And what you need to do is start chopping out the ones that aren't going to help you. So many brokerages are not remotely interested in dealing with expats, right? So we forget all those. Many of the brokerages in your home country and the fund supermarkets, they're not interested in dealing with you as an expat. So we chop them out. Many other brokerages only operate on the US stock exchanges. And of course, like, we can't buy those funds because of the whole tax situation, right? The inheritance tax situation. So we chop them out as well. So what are we left with? Well, we're left with, there's some other companies like eToro and so, which make things very easy. But there are some fees there in the way that they price things, that there are some hidden fees there that I don't love. So what we end up with is 3 brokerages that are easiest to use, which is Interactive Brokers in the US. That's probably like the cheapest and biggest and I wouldn't say easiest to use, because it's not necessarily the easiest, but it is pretty secure, and it's well covered with a kind of insurance if something goes wrong, et cetera, and it's got a good reputation, right? In 2008, during the crash, when all the banks like Lehman Brothers were failing, I think their client base went up by like 70% or something. So that suggests that people trust them, right? Then you've got Saxo Bank, that's SAXO in Denmark, and you've got Swissquote in Switzerland. Those 2, even though they've got a branch in Dubai, we can go and talk to a human being, they are a little bit more expensive. And what we typically see is quite a lot of people start with Swissquote, start with Saxo Bank, and then slowly, as they build up more money and more confidence, they move to Interactive Brokers because they want to save on the fees. And actually, Interactive Brokers has just reduced their platform fees to 0, right? So it doesn't cost anything. The only cost that you're going to have with Interactive Brokers is sending the money there, which we probably need to talk about in a second, and buying the ETFs that you want to buy. So if you've got 2 funds in your portfolio, you're probably going to buy 2 stocks every month, or 2 stocks every quarter, 2 ETFs every quarter, a stock ETF and a bond ETF. And that's going to cost you about $5 for any kind of trade that you do up to about $10,000. And that's what it is. So it is actually incredibly cheap, right? So if you cannot handle figuring out how to use the brokerage, and obviously, like, I mean, this is what I do with my weekend workshops and things like that, show people how to actually like do this, like A to Z. But if you're just too scared to do this, there are also there's also a breed of companies called robo-advisors. Sounds a bit like the Terminator. And examples would be Sarwa in the UAE. So that's SARWA. What they do is they kind of invest for you on your behalf. You're going to pay a little bit more for that, But if you're just starting out with a small portfolio, sometimes that's quite a bit easier to just get started with. But the benefit of learning how to do it yourself is that you don't need to rely on anyone else, and you have complete control over what you're doing. And then over time, after 5 years, you'll be so much better than anyone else and so much wealthier than anyone else, that you really feel that you have control. So for me, it's worth that tiny little learning curve at the start. And like literally anyone can do it. As I've said before, like even if you're an English teacher and you hate mathematics,
English teacher, what are you doing?
Then you can absolutely do this. I mean, I've taught so many teachers, including English teachers, how to do this. It is very simple. So that's roughly how you do it. You need to open up a brokerage account, and then you can go in and you can place an order and buy those 2 ETFs every single month. Or if you've got like $5,000 to invest every single month, then you can do it every single month. If you've got less than that, you can wait and maybe invest every quarter or every other month instead, and try and scrape together, a couple of thousand or $5,000, and then do that every quarter. It's good to have that regular investing, right? To have that momentum and that discipline of saying like, okay, it's the 3rd of January, it's the 3rd of April, it's the 3rd of July, I am going to invest on this day, there's my $5,000, whatever. And try and put as much in every single time, even more in every time that you do it. So that's how you use a brokerage platform.
Why 5,000 or more? And that's going to lead me into how we send the money and how we do all of that. So I know you had that caveat in there that if you've got less than that, you potentially should just wait until you've gathered some more money before you transfer it to be able to buy the ETFs. But why do you suggest that you have more than a certain amount, and how do you get it into the brokerage account?
Yeah, so what you have to be careful of is there is a fee every time you send dollars from the Middle East or anywhere over to the US. And it can be anything from $20 to $30. I mean, I literally think it's cheaper to put your money in a box and FedEx it over to the bank in America. It's kind of a ridiculous situation, right? And so we want to keep our total fees for each transaction below 1%. And so if you're sending $500 and what's known as a correspondent banking fee, right? There's a bank in the middle that sends the money over to the US and they're charging that $25. You effectively just paid 5% of your money in the correspondent banking fee, right? As your amount that you're sending gets bigger, then that $25 as a percentage of what you're sending gets smaller, right? So when you're sending $5,000, then it's only 0.5% of what you're sending. And then when you add everything up, so the exchange rate, the dirhams into dollars or the reals into dollars or whatever it might be, plus the fee to send it overseas, can add up to maybe $50, right? And so that's why it's good to have maybe say $5,000 saved up so you can send it. Now, some robo-advisors help you get around that by letting you invest in dirhams, but ultimately they're still investing in dollars. So you have to be careful about like what exchange rate are they using? Is it like a hidden fee, hidden cost to you that you're not sure about? But if you're doing it yourself, yeah, exactly. If you're doing it yourself, then everything is very, very transparent. You just have to do your best to keep the fees low. And if you use a bank, generally, then they are not going to give you the best exchange rate, and they're not necessarily going to keep fees as low as possible. And they may even surprise you with the correspondent banking fee, because they're like, well, that's not our fee, right? But you still get hit with it as it goes along, the money goes along to the US. So I actually prefer to use exchange houses. There are some online like Currency Fair that you can use, or GC Partners or Revolut. And certainly this works for dirhams. I don't think it works for reals, unfortunately. It is a bit harder to send Qatari riyals or Saudi riyals, you probably will have to deal with a bank unless you can find an exchange. But certainly in the UAE, you can use an exchange house like Wall Street Exchange. They have something called the Priority Club, or Lulu Exchange. These companies give you like literally the best rate in town for sending money over. I think the exchange rate is 3.6735, which the fixed rate is 3.6725. So it's an incredibly good rate, best rate in town. And that way you can make sure you're not wasting money. It's like leakage, right? Just money leaking out at every step, right? You minimize that leakage as you go along. And the more that you're investing, the more important getting a good exchange rate is. So if you've saved up a lump sum of $20,000 or $50,000, whatever, because you just haven't been investing for ages and you've just been sitting around in your bank account, then you should be really, really hot on getting the best exchange rate that you can get.
So you've sent it and it goes into your brokerage account. And once it's there, it lands as what? Just cash? Once you've exchanged it?
Yeah, it will land as cash. So it will probably be in dollars in your brokerage account. The nice thing about Interactive Brokers is it's incredibly cheap to change currencies. So you can convert it into euros or pounds or whatever you want to, if you really want to. Even if you're just going on holiday, you need some money. It costs about $2 per transaction, and you get the same exchange rate that banks use for each other, the interbank rate. So it is, I think, the best place in the world to change major currencies. It just doesn't accept dirhams, riyals, etc. It only deals with the big currencies. So once you've got the dollars physically, in your brokerage account, then you can do a trade. So you say, well, okay, I want to buy however many shares of, let's say you've got $1,000 to invest, you would buy 800, and you want a split for 80% stocks, 20% bonds, then you would buy $800 worth of VWRA, your global stock fund, and you would buy $200 of IGLA, your global government bond fund, and that's all you do. So you click, I want to buy this amount of this, and here's the price. And again, this is, the first time you do this, you're going to be like, whoa, because we're not genetically, instinctively born with this knowledge of how to trade, right? So you have to get past that. But once you do it once or twice, I mean, you're literally doing the same thing every month or every quarter for the rest of your working life. It becomes like second nature, and you can just nip in, takes 5 minutes, you do it. You don't read the news, you don't check is the market going up or down, what announcement is Biden about to make or whatever. You don't need that. You just go in and you do it, you get out again, and you get on with the rest of your life.
I know that it sounds very simple, but I think it's going to, it's a simple process. And yes, even I, an English teacher of English, have done it and do it every month, sometimes every 2 months or so. So yes, it is a very simple process. But what I do know is that when you do log in, the temptation is there for you to check how things are going. And you are going to kind of feel that tinge. You have to fight it. So, for example, like when I logged in recently, my IGLAs were looking a bit shaky, not doing so great. So you're thinking, but you have to fight that urge and think very, very long term. For people who are still kind of thinking, okay, I want to invest. So index funds are great. I want to do that. Do you think that's enough if you are trying to set up a retirement portfolio that's diverse? Is buying but ETFs enough, in your opinion?
I think so. The design of this super simple portfolio, the global government, the global stock fund and the global government bond fund, is designed to get you through basically any kind of market craziness over the long term, right? So this is literally all you need. Now, the financial service industry makes money from advising you, from encouraging you to do lots of trades. They make money every time you trade, from switching between different funds, from changing from one hot sector to another sector, one hot country to another country. That's how they make money. So they are never going to tell you about this simple process, right? Because they're not making any money from it, right? Remember, this whole process costs, what do we talk about? Like $25 to send the money over, plus maybe $10 to do the trade, right? That's $35. And that's it, right? So we're not giving any money to the financial services industry. So they don't want to tell us about this. This is literally all you need, and you will outperform everybody else who is using their brain and trying to do something clever, right? There are loads and loads and loads of statistics about this. If you want to dig further, you can go and Google something called the SPIVA scorecard. That's SPIVA scorecard. It compares the performance of the stock market, like the overall stock market, to actively managed funds where well-paid fund managers, fresh out of their Ferraris or whatever, in flash suits, are busy trying to outperform the market by picking certain stocks. You say, well, I'm going to bet on Apple. I'm going to go for more Apple and less Lloyd's Bank or something like that, right? And they hope to outperform the market. What the SPIVA scorecard shows, just hardcore statistics, shows that only about 8% of them outperform over the long term, in the US stock market. And it's kind of similar elsewhere. So over 1 year, only about 20% of them outperform. And then over 5 years, it's about 8%, right? So what does that mean? It means that the vast majority of active fund managers are underperforming, but they're still charging you 1 or 2% for that privilege, right? So it's a total waste of time. Just ignore it all, right? And unfortunately, most people in long-term savings plans, they are put into funds which are very expensive. Why? Because they get commission back to the advisor, right? So just ignore all that and ignore the idea that you need to invest in lots of stuff. You need to have some gold, you need to have some real estate investment trust, you need to have some crypto, blah, blah, blah. You just need a global stock fund and a global government bond fund. Halas, right? That is it. And this is where the mental side comes in, because your brain, right? We love optimizing, we love adding, right? There's been some incredible studies that show that our brains are wired for solving problems by adding rather than subtracting. So you think, oh, we just need one more fund, we just need a bit of crypto, we need this, right? Stop trying to add and just make sure, maybe if you are investing like $10,000 every single month, right, into your stock funds, and you've been doing that for 5 years now, and you've been incredibly successful, then maybe you can start playing around the edges, right? Because you've earned it. But if not, just get the discipline in place, because that will make you vastly more money than trying to be clever and throwing in different things into the mix. Now, I think if you have an itch, like if you're like, I have to buy some crypto, I have to buy individual stocks, I have to buy GameStop because Reddit told me or whatever, then you can scratch that itch, but you're firmly in the fun money category here, right? This is fun money only, which means that it could go to zero. Your core portfolio that's going to grow for your retirement is going to be boringly sensible. Your stock fund, your bond fund, boring, easy, that's it. Your fund money, no more than 10% of your portfolio. And I wouldn't say even 10% inside your portfolio, like 10% separate, right? If you've managed to save up $100,000 in your core portfolio, then I will allow you generously to play with $10,000 fund money in investing in your mate's startup, peer-to-peer lending, individual stocks, crypto, whatever, right? Like, go and have some fun, right? But ring fence it from your core portfolio, because this stuff can and does blow up sometimes completely. So it's important to realize, as you get more money, as you become a millionaire, right? And you can, as a teacher, you can absolutely become a millionaire. Look at Andrew Hallam, right? Just by, if you can save, try to save like up to 50% of your salary, keep pushing the envelope, right? Over time, over the decades, you can easily become a millionaire with your investment portfolio, right? Especially when you're outside the tax system, like those of us in the Middle East, right? The personal tax system. And so you can absolutely do this. But as you become a millionaire, the temptation to think, well, now I have to do something else. Now I have to get into hedge funds. Now I have to get into private equity. Now I have to do angel investing. You don't have to do that, right? If you look at all the big, super rich CEOs, right, who have millions to invest, a huge chunk of their money is going to be in super boring, passive index tracking global ETFs, right? Just like you. And yes, sure, they might have some spare fund money to play around with, private equity and hedge funds and blah, blah, blah. But the core is going to be solid. And it's exactly the same for you. Keep it simple and just stick to the rules. Get your brain out of the way. Read up about this. Find a community. So, you know, like there's the Dead Simple Saving community. There's the Simply FI community. These people have your back. When you start to get uncertain, when you get nervous, then these communities will have your back and they will protect you much more than some advisor who's trying to get lots of money out of you. Wow.
Thank you so much, Steve. Like there's just so much that you've given and a lot of information. But if a teacher is nervous or they want some more hand-holding and they think, you know what, Steve makes some really great point. I really need some hand-holding though. I'm still scared. How can they get in touch with you? I know you have programs. I know you do training. How can they connect with you to get some hand-holding in just starting their journey or even continuing their journey?
Yeah, absolutely. So I've helped hundreds of teachers over the years. And the first thing is you can go to deadsimplesaving.com. You can sign up to my newsletter, and I said that every 1 or 2 weeks you get interesting articles. Then also you can go to my Instagram page, which is Dead Simple Saving. I'm having fun just being there and trying to do like more live talks and things like that. And then if you just have a dig around my website and read some stuff there. But if you want to accelerate your progress, then yes, I do weekend workshops online, sometimes live, but quite often online. So I've got one in September, for example, where over the space of 2 days, literally teach you everything you need to know. What we've covered in this podcast, but just in the amount of detail you need to know to feel confident. And so you know exactly how to do everything. So it's quite a transformational weekend, and you will be a different person from, when you stumble into the workshop on Friday morning to when you come out on Saturday afternoon. And so that's a very nice way to do it in a concentrated way. Or I have a kind of online video-based version of that called the Expat Investing Academy. And or I also do private coaching sessions as well, if people need that kind of one-on-one support. And if you are a teacher, I don't really give discounts, but I am giving discounts for teachers. So if obviously you're probably a teacher listening to this, if you are a teacher, you can always message me and say, "Oi, what kind of discount are you doing?" So usually I either give a discount or I allow you to kind of split the payment up into different installments,
right.
Slightly depending on what it is. Because I know teachers aren't the best paid people in the Middle East compared to architects and bankers and things like that. So I'm happy to support them.
Yeah, we appreciate that. So if you want to get in touch with Steve, I'm going to link all his details in the show notes. But I want to say a massive thank you. You've really given us a whole lot of information. If people want to listen to this podcast several times and just follow the steps and go over it, that's also fine. But I think it would be beneficial to connect with Steve and to get a little bit more help and knowledge. And obviously his blog is also deadsimplesavings.com. It's a good blog to go and just read and digest some of the stuff that he's shared freely there. So thank you so much. I really appreciate you coming on the Teach Middle East podcast.
Oh, thank you very much, Lisa. It's been a pleasure. And yeah, just to reiterate, I mean, we have gone really fast through a lot of this stuff. So if you just felt overwhelmed with the jargon, you can go through it much more leisurely, and you will start to understand that it's not that complicated. It's just when we try to pack it into 1 hour, then it seems like a lot, but it is actually not overwhelming.
Awesome. Thank you so much.
Thank you.